Alright guys, welcome to episode number 3 of the FVT Trading Bootcamp. Now if you haven't watched the previous two, I'm going to link the previous one in the description below. We discussed candlestick behavior. Today we're going to be talking about market structure, and I'm going to do a few things today. I've got a recording of my actual screen here, and we're going to go into a few other bits and pieces. But here's the thing, right? Market structure and the way the candles print, they determine what you see on the chart. And what I've actually done here, and you can do this for yourself in your charts, if you have a look at the top of my screen here, I've clicked on this button at the top, and all I've done is this button at the top here. I'm just going to move my camera so you guys can see this little button here, right there. I've just clicked this one, right? That button. Now, when you do that, you can change between candles and a line chart. For me, candles is what I normally trade on, right? But you can use a line chart. And today we're going to use a line chart to do some study. Now, here's the thing. When we look at the markets, right, when we look at a chart like this, going back to what we talked about in the last lesson, we talked about swing lows, swing highs, swing lows, swing highs. And I want you guys to recognize that the market does only 3 things, right? It only does 3 things in terms of how it moves. Number 1, it's going to trend up like this. Number 2, it's going to trend down like this. And number 3, it's going to trend like this across. So it can be in like a channel or like a range. It can trend up, it can trend down. The way I trade, the way I'm going to teach you how I trade, can be used for all market sentiments. It can be used for all market elements, all market structures. It doesn't matter if it's trending up, trending down. It really doesn't matter, right? So ultimately, that's kind of what we're looking at here. Now, I've got the line chart up because the line chart illustrates this perfectly. You know, right now we're on the 1-minute chart, but let's just go back to, say, the 15-minute chart. And you're going to see periods of time where we're trending up, trending down, and also accumulating. So we're going to mark those out here first, then we're going to get into a bit more detail, and I'll get my camera back up and we'll go from there. So have a look at this, right? Have a look at this price structure, for example, right here. Again, the market can either trend up like this, it can trend down like that, or it can do this. It can move in a range. So what would you say, before I answer, what would you say this is doing right here? This price structure, what is that doing right here? Is it trending up, trending down, or is it a range? It's a range, right? Now, generally speaking, and we'll get into more detail about this, the way I trade a range like this, the way I do trade it, and I can give you an example today with a trade that I took in the opening range in Asian session, is say the market's doing this. I prefer when it pulls back down and sweeps liquidity, and we'll talk about liquidity in the next lesson. When it sweeps a low or sweeps a high, I prefer taking the initial reversal from here to move up. That's what I prefer, right? So I'm going to zoom in a little bit. I prefer taking this. However, right, if I believe the market's going to go up, maybe it's already reversed and we're sitting up here. I'll still take a trade if I believe these highs or the draw on liquidity, which we're going to get into, is strong enough. And I use what we call an inverse fair value gap, which is a PD array that if you're new to my channel, maybe you don't know about. If you've been here for a while, you're probably very familiar with it. And so again, you can see how the market moves, right? Ranges is how I trade those. In terms of trending markets, a lot of people ask me, you know, when a market is trending up or down, say here, even when the market's trending up, we're moving up like this, right? It's always going to pull back. It's always going to pull back. It's always going to pull back. It can't go up and down forever unless there's some crazy news event or something happens. For example, here we saw Trump speak about tariffs and you can see what the market did. But that is an outlier, right? So that's an outlier. Don't think that that's going to happen every day, because it won't. And don't base your trading on those massive expansion moves, because it's just once in a blue moon. And you can see even in a price fractal from this high to this low, right? Even in all that price structure, there's different elements, right? We've got periods of accumulation. We've got trending markets. We've got trending markets. We've got trending markets, aggressive moves, range markets, trending markets, aggressive moves. So you're going to see these 3 play out time and time again. You're going to see trending markets up, trending markets down, and the range playing out time and time again. But you need to appreciate this first on a line chart. And you're going to see this, right? If we go back, look, go back all the way, say somewhere here. You're going to see this anytime, anywhere, any month, any year. You're going to see this play out time and time again. You're going to see the market trend down, trend up, range, down, up, down, range, down. And as we get into it, you're going to see some repeatable patterns that I think are quite interesting, right? You can see here that this is a bit of a range, this is trending, this is a bit of a range, this is trending. And a lot of people like to call that, we'll talk about it later, they like to call this the market maker model, All right, so this is just ICT's thing. But anyway, I'm gonna get my camera on. We're gonna discuss now price action with the candlestick charts. Take these notes. The market only trends up, trends down, or it ranges. It's as simple as that. Let's get into the next section. Back again, we've got the charts here. This is the line chart. It's currently printing. I want to go back onto the candlestick chart to show you guys how it looks, right? How it looks there. Now, when we go back to the candlestick chart, it may seem a bit trickier, but the main points that I want to emphasize in this, lecture series, in this particular video, in this episode, is that the market cannot keep going up and going down forever. So a big part of how I trade is reliant upon the fact that if the market's been trending up forever, at some point we're going to reverse. And then once we reverse, at some point we're going to bounce back. And then once we do this, at some point we're going to do this. We can't just keep going up and down forever. Yes, sometimes there are outliers. If you look at the gold chart, for example, a lot of people trade gold. And so I'll get that up here just to illustrate the point. Yeah, sometimes, right, markets are very overextended as a hedge against what we're seeing with the overall economy across the globe. Yes, sometimes these things happen, but in the NASDAQ or on the NASDAQ, it's very rare that you're going to have a situation like that where the market for multiple days, right, is going to look, so aggressive to the upside. It's not going to happen. You can even see here, right, we have a bit of aggression at this time frame here. We have a bit of aggression up, but at some point we got to move down, right? And a good practice if you're new or even if you've been studying for a while, what I want you guys to do on your charts, right, in particular, is start with the daily chart and go over the side here, grab this tool, right? It's called the path tool. And just start drawing out the swings. Like, look at the swings, look at the market move up and look at the market move down. Look at these swings, right? Look the market do these things and draw this, right? Draw all these swings, all these major swings like this, right? Draw all the swings. It's easier to see on the line chart, but do something like this. And then what you're gonna see is that a lot of the time, if the market is trending up, in this example, obviously we can see, right? The market's trending up, we're bullish. But even when it trends up, we still have periods or channels, as you can see here, where we pull back. And we still have channels here where we pull back. And we still have channels here where we pull back. And we still have channels here when we pull back. So ultimately, even in a trending market, we're going to pull back. In a ranging market like this, we're just bouncing. It's like you've got support and resistance. Market structure, if we go back again, we can see exactly the same thing. Even in a downtrend market, right, it's the same thing, guys. A downtrend, we're forming lower highs, right, and lower lows. That's how a downtrend is confirmed. In an uptrend, the market is forming higher highs. You can see these highs are higher and the lows are getting higher too. But at some point in a trending market, yes, we may, if I draw this up, we may be forming higher highs and higher lows. Look, all these highs are higher than each other. All the lows are higher. But at some point, we have a reversal, which happens at the top. And later on, we'll talk about the reversals occurring inside of a higher time frame point of interest or a higher time frame fair value gap. So we're going to talk about those two as the lessons go on. So you need to appreciate this. Markets go up, markets go down. They can't go up or down forever. And even in a trending market, you're going to have pullbacks. So don't be fooled. And this is just the realistic viewpoint that I've had for a long time now. Don't be fooled with people saying that you have to follow the trend. That's not the case. You might be a counter trend scalper. You might like to do that. That might be your style. You need to find the concepts and merge the concepts together that you personally like. No one else, but that you personally like. And then roll with that as time goes on, right? Roll with that as time goes on. Don't be the person that tries to just follow like a sheep. Find your own concepts that I'm talking about. Combine them like you want to combine them, because you're going to find ways that your, psychology and your system works the best, right? So keep that in mind. And again, in a downtrend, look, similar kind of thing. We've got the market moving down, but we do have pullbacks, right? And we talked about swing highs and swing lows in terms of market structure. In a bullish market, we form higher highs and higher lows. In a bearish market, we form lower highs and lower lows. In a ranging market, the highs and lows like this, you can see are relatively equal, but often we break out of that. We have ranging markets for a little bit, but often we do break out of it. Even here, you can see the market ranges for a little bit. The highs are relatively equal, the lows are relatively equal, but then we break out. We range for a little bit, but then we break out. We range for a little bit, then we break out. So the market's going to constantly flow. See the market as a wave. The market moves up, the market moves down. And these are the best opportunities to, talk through. And one last thing I'll mention in this video is this, right? I'm just going to illustrate something here. say this is a market. We trend up, we reverse, we trend down, we reverse, we trend up, we accumulate, we move up, we sweep the high, we come back down. This could be a few weeks of price action or a few days, depending on what time frame you're on. Now, there's so many ways to enter, and I'm going to talk about it briefly here, but then later on we'll discuss that. If the market's trending up like this, you can take short positions. You can take short positions like this. You can counter trend short like this. Take a short like that, and you can short down, right? Or you can wait for the pullback. You can wait for a pullback into a point of interest, which we'll talk about a bit later on. Usually it's a fair value gap. We'll talk about those. And then from there, during a macro, again, we'll talk about that. You can look for the continuation. Both are fine. It really just depends on what setup presents, in my opinion, in your session. What setup presents in your session? What's the sentiment? You know, if you are a London session trader, if you're a New York session trader, if you're an Asian session trader, if you're a PM session trader, it doesn't matter. But if when you're looking at price, let's assume you trade the New York AM session, and let's say price is sitting right here. The market's bullish, price is sitting right here. You're not going to short it, you're going to long it. But if price is sitting up here, and we've got a point of interest resting over here, then you can look for a counter trend scalp. That's really important. Now, when the market reverses at the top, and we'll go into more detail about market structure a bit later on, but when the market reverses at the top, we typically, or I like to catch these reversals, and I like to continue these trend following trades until, and here's a key point, until we reach the halfway point. It's called equilibrium between the high and the low. Once we reach equilibrium, no longer trying to go for shorts. I'll wait for price to come back down. And we'll talk more about equilibrium using the Fibonacci tool, feel the bits and pieces. When the market's in a range, it's like ping pong. So maybe you do get chopped up once or twice, but then you learn that it's in a range. So every time price is down here, you look for longs, up here, look for shorts, down here, look for longs, and eventually we break out of the range. So sometimes you can, catch that breakout trade. Other times you have to wait for the breakout and then see if the reversal happens. So there's many ways to trade. You can trade counter trend, you can trade with the trend, you can trade a mix. I wouldn't be too rigid. I was always of the belief that you have to trade reversals, you have to trade reversals, you have to trade with the trend. I was always under the impression that you couldn't counter trend trade. And now I'm under the impression that you really can do whatever you want as long as you've got a system that you can follow. Right? There's so much opportunity in the market. There's longs and shorts every day. There's people making money going long. There's people making money going short. So please do not be concerned with what maybe you've heard with people saying you have to follow the trend. You can't take shorts if the market's bullish. Not right, in my opinion, because you might be that person that likes to counter trend scalp. I think it's best, talking about market structure, to have the ability to take longs and shorts, to take trend continuations and reversals, and to be able to have a model and a system, which mine is, that actually allows you to trade in these different market conditions. Simple as that. So take notes. The main thing today, guys, markets trend up, markets trend down, markets go across. We can take longs, we can take shorts. We've talked about market structure. We've talked about a little bit about pullbacks. And in the next lesson, we're going to talk about a little bit more in terms of liquidity, because again, market structure, liquidity, these basic concepts, candlesticks, you need to understand this in detail before you can move on to any sort of entry model, any sort of, strategy. You need to understand this first. With that being said, guys, happy trading, all the best. We'll talk very soon. Peace.